Starting. All attendees are in listen-only mode.
Okay, welcome to our latest webinar, tax-linked webinar. Today we're tackling Donald Trump's tax plans for the USA. We're going to see what's in store for the country in terms of the Trump administration's proposals in terms of domestic tax, international tax, and so forth. So just let me get some administrative issues out of the way. Those people who are listening in, feel free to submit questions. You can use the control panel to submit your questions. If anything comes up as you hear our panelists discuss the issues, feel free to submit them, and I will try to work them into the conversation. I'm going to be moderating. Also, there will be, we're recording this session, so there will be audio recording of the session that should be released shortly after the webinar, and we will also have a full transcript available to everyone who's listening to and to all of our members. So with that said, I'm going to ask each one of our panelists to briefly introduce themselves, and then we'll get started with our 10 questions which have been sent in by our members. So Virginia, could you please tell us a little bit about yourself?
Sure. I'm a U.S. tax attorney. I've been practicing for just about 34 years now, and I have been living overseas for well over 30 of those years, and working with a lot of international flavored U.S. tax. So what's happening with the administration is of great interest to me because there's a big impact on a lot of the clients I work with, and I'm looking forward to helping out and getting people to have a better understanding of what's been proposed in our webinar today.
Excellent. Thank you, Virginia. Noah?
Yes, hi. I am Noah, Noah Gaoua, and I'm specialized on international tax law. I have experience in Amsterdam because I lived there for almost 3 years, working in a IBFD international organization. Now I am working as an in-house lawyer in a billion firm in France, actually. I own a PhD from La Sorbonne, and my interest is international taxation, and this topic is particularly hot because they might change a lot of the scale or nothing. So I look forward to discuss and move on with this topic.
Excellent. Thank you, Noah. Paulus?
Yeah, hi. Thanks. And hi, guys. My name is Paulus Merks. I'm an international tax partner with DLA Piper based in Amsterdam. I've quite some experience with U.S. multinational companies doing business all over the world, and as my special focus is with Europe and with the Netherlands. So I'm very much aware of these U.S. tax issues currently pending and their impact on U.S. multinational companies.
Excellent. So, okay, to get us started, I have 10 questions that were submitted by Virginia and by many of our members, and we're going to try to, get through most of these. This discussion should take about an hour. They see things are heated and we're doing well. I'll extend it to about an hour and 10 minutes or so, but it shouldn't go above that. So just to start with something rather general or something broad, what proposals have been made to change the tax rate structure in the United States? Virginia, do you want to get us started with that one?
Sure. Currently, we have, under the U.S. system, we have 7 tax brackets, and they start at the lowest rate of 10% and go all the way up to 39.6%. You can add on top of that 39.6% at the moment a 3.8% surcharge, which is known as the net investment income tax, which will put certain taxpayers on their investment income. This was enacted to fund the Obamacare program, so it's sometimes known as the Obamacare tax. So really, you've got a tax rate structure of 7 brackets from 10% to 39.6%, and the proposals under both the House Republican blueprint and also the Trump proposal, both of these propose only 3 tax brackets with rates of 12%, 25%, and 33%. And it's a pretty big drop, and that would be pretty nice. But of course, everything good we have means that something bad up to the revenue goal. But that's the basic picture.
Okay, Noah, any?
Yeah, yeah, maybe a few comments. I definitely agree with what Virginia just said. It's a good picture of what's going to happen. We can see that there is a will from the US to become more attractive, and with this respect, they definitely decided to reduce the rates. With regard to the base, we don't know exactly how the base will be. Will it be reduced or not? However, this is the trend. They trend to be quite a bit aggressive with regard to tax rate, with what we can see. It seems to be a plan to attract companies, maybe to attract only US companies in their own countries. And as they said, as Virginia said, there is what Trump proposed originally, for instance, for the corporate income tax. It was proposed to reduce from 35% to 15% the federal tax. However, the House of Republicans came just earlier with a new proposal, which is also in the same trend, but not the same level. So they want to reduce the CIT rate from 35 to 20. So more or less it's the same trend, just details will be modified, but the trend is that they want to be aggressive with this regard.
Okay, Paulus, any comments on
the webinar?
Excellent. Virginia, actually, before we move on, Virginia, can you speak a little bit closer to the microphone? It breaks up a bit. Okay, perfect. Paulus? Yeah.
Yeah, Matteo, thanks. And I think it's a great question. I guess we have to see how this eventually will work out. And I guess not so much the House will be an issue here. The real issue probably will be the Senate, with like a 48-52% split between Democrats and Republicans. So the question there is whether the Republicans will make it there. I mean, only two have to change their mind, and it will be a 50-50. So it's still going to be very interesting to see how this will work out politically. Also, I guess we have to keep in mind this will not be implemented. Things that will be implemented retroactively. The earliest date that this will be entered into force will be January 1st, 18. So that is, I think, also important to keep to mind.
Excellent. And since we're having the discussion basically about we brought up the subject of tax cuts, I guess. If we look at a question that was submitted, since tax rates will drop overall under Trump's proposals, how will the proposals offset the inevitable revenue reductions? We all know that they cannot let the federal deficit skyrocket. So how will the proposals claw back some revenue? I mean, what's in store in terms of making up for the lost revenue from these proposed tax cuts? What does the Trump administration have in mind regarding that? Noah, you want to get us started with that one?
Yeah, fine, of course. This is quite the most hardest question with this topic, in my opinion. As every politician and as every year, when there is a new budget, there is only the same goal, which is tax neutrality. So whatever they do, they always say that they will focus and try to achieve what they call neutrality. So even though there is an increase of taxes, there will be exemption in the other end, so they will be neutral and nobody will be affected. But that's going to be difficult because it's impossible to measure neutrality with this regard. But when you come to the question, which is where will they fund the money, the most obvious answer is the border adjustment. So we are talking about maybe 20%.
Border adjustments, the Tax Foundation did a little research on that. No, I don't know if you found that information, but it said with the border adjustability, it's supposed to raise $1.1 trillion of revenue. over 10 years. So like you say, that is where the bulk of the money should come from. And we know that border adjustability is going to have its own issues. But that's the bulk of it right there. If you don't get the revenue from border adjustability, there are other places that will come in, but that's the main source.
Yeah, indeed. I think this is I didn't have this number, but it's huge. It's huge, and I think this is a good source of money. But I found something else. I think the Congressional Budget Office said that they will end the temporary tax expenditure on schedule, which means that they plan to save at least, or maybe a maximum, I think, 400 billions of tax revenue saved. I think this is it. The most obvious answer is the border adjustment, but it will be still difficult to measure this neutrality.
There are a few other places that are planning to claw back some revenue, so I can add to that if you'd like me to, Mateo.
Please go ahead, Virginia.
Okay. The House Republican blueprint is going to be repealing under their proposal something called itemized deductions. And we have under our current system a lot of deductions that people can use to reduce their taxable income. For example, the biggest one is the home mortgage interest deduction. That one, by the way, will be retained under the House proposal, as well as a deduction for charitable donation. But there are many other deductions people are used to taking if they are doing something for itemizing their deductions. So, for example, you can deduct state and local income taxes that you pay. You can deduct real estate and personal property taxes that you may pay in your state. You can deduct casualty or theft losses, certain medical expenses, and the list goes on. All of these others under the House proposal will actually be repealed. They'll be taken away. And in addition, the House proposal repeals something called your personal exemption amounts. And for 2016, for example, that personal exemption amount is worth over $4,000 per person. So if you were, a parent with 2 children, you would get your own personal exemption amount and one for each of your 2 children, leading you to have a deduction from your income of over $12,000. That's going to go under the proposal. But what the proposal does is it gives you what I call a super standard deduction. It takes away all of this other stuff, and then it gives you this gigantic one, so it'll give you what's called a larger standard deduction amount. Instead of taking all the little deductions, you'll get a big standard deduction. And it's a different amount for different people, depending on your filing status. So if you're married and you're filing a joint return with your spouse, your super standard deduction would be $24,000. But if you were single, it would only be $18,000. And the Trump proposal is he doesn't take away all the itemized deductions, but he limits them to $100,000 per person. And he increases the normal standard deduction, but he repeals all these personal exemption amounts. That was the $4,000 amount I mentioned you get for yourself and your kids, for example. So they're all trying to tweak the system a little bit to say, okay, we know we're losing money because of the tax bracket drop in rates, but we have to get it back somehow, claw back. And this is one way they have found to tweak the system a little bit and get some money back in. But again, as Noah has pointed out, the big revenue raiser is that border adjustability feature in the plan. So without that, as I said, the Tax Foundation's research indicates it's supposed to bring in $1.1 trillion over the next 10 years. These little tweaks, I don't think they're going to make that big a difference.
Right. Thanks, Virginia. Paulus, anything you'd like to add on how the government is going to make up for the tax cuts and revenue?
Yeah, I very much appreciate what Virginia just said. I think it's good to keep in mind that the U.S. obviously comes with like a 35 corporate tax rate, was like one of the highest rates, federal tax rates in the world. And so while we see like a global development that corporate tax rates are going down, the U.S. stuck to that 35% for the last decades, and it was evident that they have to do something, and that 35% that makes sure that U.S. multinational companies, it's very hard for them to compete. So it's a tremendous cost, and the U.S. has to do something. I think everybody within the U.S. is aware of that. So the question is more, how are they going to do that, and what makes sense? I think the proposal that we see now with the border, the international border adjustment, I think that the painful part of that proposal is that it has significant winners and it has significant losers. The significant losers are the multinational companies with operations outside of the United States, with operations in production in Mexico, production in China, for example, and they're gonna be hit very hard by these proposals. So we're speaking about the Nikes in this world. So for them, it's gonna be very tough, and it's gonna be a very significant burden and tax raiser potentially. The related question to that is, how realistic is that plan? And we know that at this point in time there's a lot of lobbying going on in Washington to either tweak the international border adjustment or to make sure that it will never happen. So the question is, will these proposals make the House? And what I mentioned before, even a bigger question mark is, will this proposal also, will they go through the Senate? And again, that's a big question mark. For example, a company that's going to be hit hard by this proposal is Walmart. Walmart is the HQ of Walmart is based in Arkansas, and Arkansas has two senators in the Senate that have like a Republican background. Again, if these two senators are gonna change their minds, it's going to be a 50-50. So let's see what happens there. I'm a little less optimistic there than Mr. Trump.
Excellent. Since we're on the subject of the border tax adjustment, I just actually got a good question from one of our listeners, and basically what he's asking is there any guidance as to whether this tax, if it goes through Congress, how will it impact services as well as goods? I mean, will it also have an impact on services, or is it primarily on goods? Any thoughts on that? Virginia, go ahead.
You know, I was just going to say, can we step back? Because Paulus seems to know a lot about the border adjustability impact. And I was just going to say, there's so many listeners out there that might not understand how the proposal works. If Paulus could, or Noah, or Matteo, if you wanted to, give us just like a bird's eye view of what does border adjustability mean. So maybe the listeners can put it more into context. And then we'll shoot to that question about, hey, what about services? Because typically what's getting imported are goods, and you don't get to take a deduction for goods that are imported into the U.S. from a foreign country. That's like one of the bases of the border adjustability. But I thought it might just be helpful if maybe Paulus could give us just a brief bird's eye view of what it means, and then we can address that question.
Paulus, you want to tackle that? Give us a bird's eye view of the border tax adjustment.
Let me take a first shot at that. And in fact, and this is a European. I'm sure that Noah will jump into. So we tend to call it a sort of a VAT, so a value-added tax that applies to goods. However, it's not a VAT is like an additional tax that goes on any transaction. In the Trump proposal, what we see, the tax will only be assessed on goods that will enter the United States. So in fact, it's a tax at the border, and a tax that does not apply on goods on any transactions within the United States or any sales or transfer of goods that go outside of the United States. So it's more like a kind of a duty on goods that they're going to be paid when these going to be entering the United States. So again,
so back per se on the goods coming in, it's still part of the U.S. corporate income tax structure. And that's where it gets very confusing. In other words, like your VAT that you have in Europe, you guys are familiar with that. It's something that a lot of countries have, but this proposal is not a strict VAT.
Yeah, I fully agree. I fully agree. So it's very different, and from that perspective, it's very different. And so it's not, again, it's not within the United States as a VAT is within jurisdictions. It's not a case. So it's from that perspective, it's very different. And again, it will hurt the U.S. multinational companies with production outside of the United States that are importing goods inside the United States, and it may hurt them significantly.
Yes, thank you. I really appreciate what Paulus just said, and if I may, I would like to add two remarks. The first one is with regard to Virginia's request. If I try to simplify briefly and roughly what is this border adjustment, is just two ways levy, which means that profit for exporter will be exempted. So U.S. industry that exports goods will be exempted for some taxes at certain levels. So there will be incentives. In the other end, U.S. company that imports goods will see all the incentive repealed. So there will be an increase of the tax burden with this regard. So this was my first remark. And the second one is this this debate with regard to is it a VAT, yes or no? The answer, of course, is no, because VAT is a friendly business taxes, which means that final consumer has the burden of the VAT, not companies. For companies, VAT is neutral. Let's imagine that you are an entity in Europe, France, for instance, and you are in a position of Walmart, which means that you import goods. What's going to happen is that you import goods exclusive of VAT. The invoice you will receive will indicate no VAT, and as a French entity subject to VAT, you will have to assess yourself the VAT, and you will have to pay it. Until now, it is quite similar. However, the difference is now, under the VAT regime, the VAT is neutral, which means that you have a VAT credit. Either you can offset it with VAT, or either you can ask refund from the government. But VAT will never be a burden. When it comes to this border adjustment, Walmart in the US that will pay this 20% will have no way to get a refund or to offset this border adjustment. Therefore, this is a tax.
Right.
I think to make it really simple, let's just take an example and say Walmart imports, I don't know, some sneakers into the U.S. and it pays $100 to the Chinese manufacturer for those sneakers. And then when Walmart sells the sneakers, it sells them for $110 to the customer in the United States. When Walmart has to pay its income tax to the U.S. government, under the normal rules that we have today, it would say to the U.S. government, look, I paid $100 for the sneakers from the Chinese manufacturer, and I sold them for $110. I only have $10 of income, and I'll pay my tax of 35% on that $10. What border adjustment says is, now we change the game because now you've imported the sneakers. You don't get to take away, you don't get to deduct your cost of goods sold. So no longer do you get the $100 deduction. You will have to pay tax on the $110 because you don't get your $100 deduction for the cost of goods sold. And this is where the border adjustability comes in. It's still part of our income tax to be paid by the corporation. So it's not really the VAT that you're normally hearing about. Noah has described previously that VAT is kind of tax neutral in a way. It's borne by the consumer when he buys the goods. This isn't the case with the border proposal in the House Republican plan. And I think a simple example might shed some light on how this works. And that, by the way, is why we may have some problems. I'm not a World Trade Organization expert by any means or an international trade expert, but some of these are the issues that are being raised as a problem under the WTO.
Thank you, Virginia. We actually, as a follow-up, there's another question submitted by one of the listeners, and his question again has to do with VAT, but it's more specific. Basically, he's asking, will the U.S. ever see a VAT to replace sales taxes? Is that a possibility in the U.S.? Is that a possibility under the Trump administration? What are your thoughts on that question? Paulus.
That is not that's like a question that already was there like 10, 15 years ago, and always has been a big question mark. I think if you look at the Trump proposal, and it's called by Mr. Trump the tax reform that will make America great again. One of his plans is also to simplify the tax code, and if you're going to do a VAT either in addition of a sales tax or like as a replacement for a sales tax, that's going to be highly complicated for a country that has no experience whatsoever with the VAT. So I think, in short, my answer is I think it's going to be very unlikely, and definitely under the Trump proposals that there will be a VAT in the U.S. anytime soon.
Okay, Noah, any thoughts on that? Or?
Oh, Virginia first, please.
No, I
Virginia,
think
go
I'll
ahead.
second.
Okay.
I think that's probably accurate. Not that we have a crystal ball.
Yeah.
Sounds right.
Yeah, and in my opinion, it's quite a pity because what we see now with the border adjustment, it looks like what we had in the past, which means that we go back to the past with this kind of taxes, because it looks like turnover taxes, and this is why in France we replace turnover taxes, which was a burden for company, with VAT, which is neutral, because turnover is a tax on each turnover and on each value of the chain, and at the end of the day, then the chain value is not effective, and the product at the end of the day is very expensive, and company see its tax costs increase dramatically.
Okay, Virginia. You.
Right.
Okay, and if I go back now to what originated this entire discussion on the cross-border adjustment tax, when I mentioned services, whether services would be included, I got a clarification from the listener, and he was saying that there's a suggestion in the UK press, he read in the Financial Times, that imported services might also be caught, and hence his question. For example, he gives the example of the Bermuda insurance and reinsurance industry, and they are concerned that it might apply to the reinsurance that U.S. insurers buy an increased price by 20% compared to reinsurance locally. So he was coming from that perspective in terms of whether services would fall or would be affected by the border adjustment tax. Any thoughts on that? Paulus? Sorry, Paulus?
Yeah, I've seen that too. I read that too, and I know that rumor too, and it's I don't know. I think in the original Trump tax proposal, it was like mentioned as an implement tariff on imported goods. I wouldn't be surprised if it's going to be wider than that. I think it's a fair question, and it's a fair concern.
Noah, any thoughts? And then we'll go to Virginia.
I have
no,
a
I think
feeling they're going to have to find a way to tap into the services as well. I just can't see it escaping. I think there's a good chance that, yeah, they'll find a way. Remember, we haven't seen any language yet, and there's always a big, big difference between, gee, this is a proposal and this is actually the language that they come out with for the proposed law. So, you know, there's plenty of time where they can be thinking about things and say, oh, gee, we kind of forgot about this, and let's add it in. It's very early days, but I think there's a good likelihood that services will somehow be dragged in.
Okay. And Noah, any thoughts?
Yeah, no, it's a good remark. I think there might be a difference between the proposal and the text at the end of the day. Yeah, definitely.
Mm-hmm. Yeah. Okay. Since also now that I recall that the WTO was mentioned, we have a question from one of our members in the original list regarding the WTO. The specific question says, what will the WTO's reaction be to Trump's new tax policies? How long will it take for other countries to be able to sanction the U.S.'s behavior? Is there any procedure that can be initiated that could shorten these times? Here we're talking about how countries are going to react to the I guess the cross-border adjustment tax. Noah, you want to tackle that first?
Yeah, of course. I think, as it is obvious, this measure and the policy behind this proposal are definitely in violation with the World Trade Organization rules. So definitely there is an issue, because US is a member of this organization and should respect some rule, including not engaging itself into extreme protectionism or mercantilist policies, and this looks like a lot. Therefore, with regard to the procedure, I think there might be a resolution that can be adopted, and if it goes further, then US will have to leave its seats from the WTO, and this will be not so good, because every country will now, after that, will be able to do the same thing to the US, because now every country which are a member of the WTO have to behave in good faith among each other. So no protectionism, and try to encourage free trades, low taxes, and if they don't, then a resolution might be taken. If they leave the WTO, then there might be a restrictive measure from every country. But I'm not sure it will be so quick, and I didn't see any quick procedure to accelerate this trend.
Okay. Paulus, anything to add on that discussion on WTO?
Yeah, and I fully agree with what Noah said. I think in addition to that, so what we obviously we're going to see a tremendous pushback from the big manufacturing countries in this world. So Mexico, China, Malaysia, Korea, a big part of Latin America, they're gonna be big losers based on this proposal, and obviously they're gonna defend themselves and they're gonna challenge this proposal. So I think we can expect a significant pushback from these countries.
Mm-hmm. Okay. Virginia, any thoughts?
Yeah, is something I've read. This isn't, as I said, not my strong area at all, but I was curious when I saw that question come in, and I did a little bit of research. And from what I had read, generally speaking, you need to wait until the law comes out so that you can see what the language is, and then the WTO will examine it, its panels of reviews will examine that and see how is it against WTO policy, does it fit, etc. And this whole process, from what I read, can take like 3 to 5 years, which is a long time. And then I was reading something else, that under the agreement on subsidies and countervailing measures, that's the SCM agreement, there is an expedited procedure to see if there's an export subsidy going on, and that procedure can actually really expedite things, and I think they can form the panel and start to review within the 90-day period. So one of the authors on this piece was saying it's possible the SCM agreement might be invoked to actually try and shorten the time frame to get some action going if people and industries feel that this is an export subsidy. So obviously people are very concerned about it, and you know, they're already planning their pushback strategy maybe in the event that it actually becomes law.
Thank you, Virginia. Now let me track back a little bit and go back to the discussion we were having earlier on corporate income tax reform. I got another question from one of our listeners, and his question is, how are foreign companies with substantial presence in the United States preparing for the various possibilities of U.S. corporate income tax reform? Paulus, you want to get us started with that one?
Yeah, that's a great question. It's a little bit that is still a little bit unclear how that will work out, but it's very clear that foreign companies with significant interest in the United States are nervous that one way or another they also going to be affected by the international border adjustment, for example, and by the U.S. The new U.S. tax system. Again, there you have the good part to them may be the lower corporate tax rate for C corporations. So in other words, there may also be a sweetener under the Trump proposal for these foreign corporations. But everybody's a little bit nervous to see how that's going to play out for them.
Okay.
And
anything to add?
If I may, thank you. Yes, if I may add a concern, I will be very curious to see how Mexican and U.S. transaction will be considered, because if I remember clearly, this border adjustment was proposed at first glance only for Mexico, and now there are some multinational groups with companies in the U.S. in Mexico who have several intra-group transactions, and I'm really curious to see. And if anyone has a clue, of course, can share, because this is a concern. And as Paulus says, it's not clear. We know that there will be attractive incentives, lower tax rate, but also we are quite worried about cross-border transaction. This is the most important issue to look closely.
Okay. Virginia, anything to comment on our member's question? No?
I don't really have anything on that one.
Okay. Paulus, would you like to comment on Noah's question regarding U.S.-Mexico relations, or do you have any insight into that?
No, not specific on that relationship, but I do have on. So indeed, as Noah mentioned, so the nervousness is on the cross-border transactions and on cost recovery. So foreign multinationals doing business in the United States, what will happen to the cost of their investments, and what will happen to net interest expense, and will that still be deductible going forward? And that's a big question mark.
Mm-hmm. Okay. Excellent. Since we are, I guess, talking about bilateral relations, I have a question here from one of our members regarding the double tax avoidance treaties. Will there be any changes to the double tax avoidance treaties signed by the United States? Will Trump's policies affect these treaties in any way? Any insight into those? Noah?
Yeah. I think. No, I don't think. I know that there is a procedure to modify a double tax treaty. It has to be bilateral. Both both party has to agree, and this is a long period process. It takes years, maybe 5 or 6 years from the day you decided to change a double tax treaty or to terminate it, and till the day you do. Therefore, Trump reform or US reform will not have direct effect to the current DTT signed by the United States with other countries, of course. However, it seems that US wants to renegotiate, so it will take time, but obviously they will. And why do they want to do that? Because they recently published a new US tax treaty model which includes specific anti-avoidance clauses. For instance, one of them denies the benefit of tax treaty from what they call income subject to preferential or low tax regime, which means that tax exempted or low tax permanent establishment might be excluded from the PE benefits. And this is the trend, because in France we had some case law that say more or less the same. So if you have in France a treaty with another country, Liban for instance, and the entity in Liban is performing services to a French entity, according to the DTT, if you do not have a PE permanent establishment in Liban, you are entitled to treaty benefit and pay no withholding tax to France. However, judges said that if in Liban the service provider does not pay taxes, like zero or a very small forfeit taxes, then tax authority has the right to challenge the benefit of the tax treaty, therefore ask the French entity to withhold the 33% withholding tax. And this is more or less the same clauses that the US wants to include in the new tax treaty. But of course, this will concern only new tax treaty signs and renegotiated tax treaty. The current one will not change.
Okay. Paulus, anything to add there?
Yeah, so maybe actually, well, maybe 2 points. So one is to Donald J. Trump. He mentioned he wants to make the U.S. tax code more simple. If you include in the U.S. tax code the U.S. tax treaties, including the new U.S. model treaty that was mentioned by Noah, that's anything but simple. So based on that aim, based on that goal, you may expect him to change the treaties and also make the U.S. treaties going forward maybe more simple. But I guess actually that is wishful thinking. What we do have to keep in mind too is that the U.S. is one of the few countries in the world whereby international tax treaties do not overrule domestic legislation. It's in fact a system whereby more recent legislation overrides older legislation, including treaties, and we call that treaty override. In other words, if the new Trump proposal will change an existing treaty, the U.S. is not necessarily has to change that treaty, but already based on the domestic legislation, that treaty is set aside. In other words, they don't have to change the treaties to make the new Trump policy work.
In short terms, Trump trumps. Okay, so
exactly right. That's exactly right.
Yeah. Okay. Thank you for that. Let's move on to another topic. What's planned for the U.S. in terms of the state taxes? Virginia, you want to get us started with that one?
Sure. State taxes, people know what they are because different countries have different rules on this, but the U.S. rule works this way. If you're a U.S. person and you pass away, you are basically replaced by something called your estate, which is comprised of all of your worldwide assets, not just what you have in the U.S. We are big on the worldwide system. So your worldwide assets, you add up the fair market value of those, reduced by any of the liabilities that your estate may have. And you have to pay a tax on the fair market value of the assets in the estate. And you get an exemption amount, which is current for this for the year 2016. It's worth $5.49 million. So if you die and you earn less than that, you will not have any estate tax due. I'm sorry, that's 2017, not 2016. So when you die, if your estate is valued at over that amount, then you are going to pay a state tax of 40% on the fair market value of the asset. So that can be a pretty big chunk of change. Now, the House Republican blueprint is saying they want to repeal the estate tax, and they want to repeal something called the generation skipping transfer tax. The proposal does not talk about repealing what we have, which is also a gift tax, so that might be retained. The gift tax is basically a backup to an estate tax. In other words, if you give away a gift during your lifetime, you will have to pay a gift tax on that, so that you don't just say, well, I'll give away everything during my life and I'll die owing nothing, and therefore I won't have to pay estate tax. The gift tax backs it up and makes sure you pay something. They get you coming and going is the basic idea here. So the House proposal would do away with the estate tax and the generation skipping transfer tax. Trump would also repeal the estate tax, but he would make the estate pay tax on capital gains if the capital gains inherent in the assets at the time of death exceeded $10 million. So there would be an exemption for $10 million for capital gains. Anything above that, the estate would have to pay capital gains. So we've seen a lot happening with the estate tax over the past number of years, including during 2010. It was completely repealed for 1 year. It's just an area that's been very ripe for amendment and change, and it's, by the way, all these amendments and changes, they keep talking about tax simplification. Honestly, in 34 years I've been practicing, I've just not seen it. Every time they talk about tax simplification, it seems to get more complicated to me, because they don't blow up the system and start with something new. They tweak this and tweak that, and then they find out that all these little tweaks didn't address certain issues, and the practitioners are stuck not knowing what they wanted to do with these other sections. And I don't know if Noah and Paulus have kind of had that experience, but the U.S. tax practitioners, this is something that we are faced with all the time. So I just don't know what's going to happen with all of these proposals and changes that they have coming in the future, and where they tell me I should be able to do my taxes on a form that's the size of a postcard. I'm really waiting to see that happen.
Noah, any comments on that, on the estate tax first of all, and the simplification of the U.S. tax system?
Yeah, honestly not so much, because Virginia did a great summary, and she went further than I can go, because this is not my field, my comfort zone. However, again, the U.S. proposal proposes to simplify and to repeal the estate tax, and it's relevant that, as Virginia said, that if it goes, then it can come back through capital gains after. Even though we can just stress that the House of Republicans proposed to go further and to have 50% exemption on capital gain, which means that the tax base will be reduced and divided by 2. So this will still reduce the amount of capital gain tax. Yeah. And for simplification...
Paulus, anything to add to...
Yeah, I guess on the simplification of the U.S. tax code, and I like I like that. How can someone not like that proposal? I think it's going to be, and I agree with Virginia, it's going to be very difficult, especially given the fact that also Trump wants to close at the same point in time, he wants to close all kinds loopholes within the U.S. tax system. Typically closing loopholes means additional rules, additional legislation, and exceptions to the exceptions. And in other words, I've never seen a tax code that is where loopholes are closed, that it's getting more simple at the same point in time. I think that's going to be very, very challenging.
Excellent.
Absolutely.
That makes perfect sense. Right. Okay. Another question now on foreign corporate earnings. What about foreign corporate earnings that were earned offshore the U.S. and are being kept offshore? Accumulated foreign earnings. How is Trump going to? How are Trump's plans, I guess, in terms of taxation, going to affect these foreign corporate earnings? Paulus, you want to get us started on that?
Yeah, sure. Happy to do. And so the plan is obviously there to introduce a 10% rate for previously untaxed foreign earnings that come back to the U.S. And if you look into the House Republicans' blueprint, there was even a little lower. There was like an 8.75% rate, meaning that the trillions of U.S. dollars that are outside of the United States is going to be very tempting for U.S. multinational companies to bring that back to the United States. The big question, and I haven't seen, maybe it's out there, but I haven't seen it yet, is like, what will happen for the U.S. multinational companies that leave cash outside, hidden somewhere within the corporate group, that they're not repatriating back to the U.S. Will there be a tax hit on that or not? If not, still the 0% environment that this earnings can get in many jurisdictions can still be very tempting. So the question is what will happen there. Having said that, I think if indeed this is going to be a 10% rate, or it's going to be even better, at 8.75% rate, as was mentioned in the House Republicans' blueprint, it's going to mean a tremendous repatriation of offshore cash back to the United States.
Which is what they want. That's why the deal looks so sweet. And even under the Republican blueprint, they're giving you 8-year time period to pay that tax. So they're allowing you to have like a nice installment plan. Whether or not you're going to have to pay interest on it, of course, they don't discuss. And, you know, I think one point you made, Paulus, the point you said where they can still keep the money offshore, will they still have zero tax on that if they keep it offshore? This is going to be a loophole. And I think when they really come out with the law, they may say, oh, we got to plug that loophole somehow, and maybe we should have a penalty on them if they don't bring it back within a certain number of years. And I just think this is an area where it exemplifies your point that when you see a loophole and they try and fix it up, it just makes things more complicated. So yes, it's a great idea to try and repatriate earnings at such a low tax rate, and it will be very tempting to do that. If companies want to keep the money offshore, do you really think they can still keep it offshore at 0%? I don't know.
Yeah. Noah, anything you'd like to add?
If we go further to your top, both of you, then this means that on the one hand, repatriation of those huge amount of cash will be taxed at 10% maximum, and on the other hand, cash left abroad might be taxed on what can be a deemed repatriation tax. Then this tax should be at a higher rate than the repatriation tax, otherwise there will be no incentive to do so. So there might be a huge penalty tax to close this loophole. This is this is a kind of scenario that is possible to request the US company to repatriate the cash. But this is a bit, at least things will change, because we saw this repatriation tax in 2004, I think, or maybe before with President Bush. And if I do remember correctly, this repatriation tax was at 5% rate. So this is already a higher rate than before. So we can see that US government is really seeking for money. So those scenarios are possible.
Excellent. Thank you. Okay. I think we have time for 2 more questions and then we'll wrap up. Okay. This question again I think was submitted by Virginia, so I'll let you tackle it first, Virginia. What's in the cards for the taxation of carried interest?
Carried interest. I'm not sure everyone knows what carried interest is, but basically it's comprised of the fees that are charged by investment fund managers. It represents really a portion of the profits they get from the investment, and it's kind of a performance fee for them, rewarding them for enhancing performance of the hedge fund or whatever fund that they are managing. And the taxation of carried interest has been really controversial for the past 8 years. Currently, carried interest is taxed at favorable capital gains rates because the investment that they get paid from, if it's long-term capital gain that's been earned on the investment, the long-term capital gain rate will carry over to the investment manager who managed the fund, and he will pay tax at only 20% on that long-term capital gain. People have been angry about that because they're saying these fund managers, like the wealthiest people in the world, why should they only be paying tax at a 20% rate when the highest tax rate is 39.6%? And really what they're getting, it's not, they're getting something for their performance, so it's equivalent to like compensation instead of some kind of like equity investment. And this side of the coin says, well, they should be taxed just as if it's compensation income, and they should pay tax at whatever marginal rate they're at, and most of them would be at the 36% rate. So it's been a problem. It's been a very controversial issue. It's come up in prior tax proposals to tax the carried interest at ordinary income rates, but it's never happened. And there's nothing in the Republican blueprint that I've seen on carried interest. But the Trump proposal has actually said, well, we think that they should be taxed at ordinary income rate rather than the current lower capital gains rate. So there's a lot of fund managers that might be very unhappy with Mr. Trump at the moment. But let's see. You know, I've seen this proposal come up time and time again where they did want to tax carried interest at ordinary rates, and the lobbying that went on was so intense it just never came to fruition. So we don't know what may be the road here.
Paulus, any comments on carried interest?
Yeah, just a very quick comment. So when Trump in the Trump proposals, and this is a side topic, he mentioned under the he mentioned the death tax as an unfair death tax, and he plans to end that. And he said that he motivated it by, so why should we hurt families for achieving the American dream? If you look at the fund managers and the carry interest, that is why these fund managers are achieving the American dream. And then the question comes up: why do you want to punish these fund managers for that? So very similar.
The argument, right? Noah, any thoughts?
Yeah. No, I agree with both of them. I think I agree with Paulus. Yeah.
Excellent. One last question. This one is actually from me. How do you guys perceive Trump's position on the OECD-led initiatives? I mean, how is the U.S.'s participation, let's say, in BEPS or CSR? How is that going to change now with Trump in power? Any thoughts? Any ideas of what path the U.S. will take? Will it remain the same, or go ahead, Noah?
To my opinion, it might remain the same because it cannot be more let's say, U.S. interest driven that it is already. I mean, taxation of digital economy and so on, we can dream about it. I mean, U.S. before Trump was defending U.S. interests, and they will do so. If they can do worst or maybe most, I will be surprised, but I think the trend is the same.
Right. Paulus, do you agree? Or?
Yeah, I agree. I agree to that, but I think it's going to be. It was so far. It was pretty implicit. And if you look, for example, in the G20 meetings, the U.S. was still supporting the OECD proposals. I think now it's going to be more explicit. And Mr. Trump made it very clear that he's America first, meaning that the OECD and including the OECD BEPS proposal is at best going to be second.
After the Netherlands.
CRS, what do you think, Paulus?
After the Netherlands, right?
Sorry?
Can you repeat that question, Virginia?
I think it will be the same for CRS, the Common Reporting Standard.
Yeah, I think so too. Yep. So there will be.
I don't think it's going to happen.
Virginia, yep. Virginia, so yeah, I appreciate the question. And there will be a very significant, not invented here kind of policy. So if it's not invented by Mr. Trump or his cabinet, it's going to be a challenging, and so the OECD will definitely going to face that.
Right. Okay, I think that brings us to a wrap. Lim, I want to ask each one of you for your concluding remarks and I guess tips to our members or other practitioners, or what to expect from the Trump administration moving forward. Virginia, do you want to get us started with some concluding remarks?
I think we're just going to really have to sit tight and be very patient and see how this all comes out, because, as I said before, proposals are one thing. We haven't seen language yet. And once you start to see the language, that's when, you can start baking your cake a little bit. Right now, it's, we have ideas. We see things coming back and forth. But, and it's always been my way, is just to really sit back and wait until you see what comes down the pike. I mean, if there's something you could clearly do to counteract something or other, then yes, you might want to do that. But at the moment, I'm not seeing anything, and I am overwhelmed with the amount of information that's been coming out in all of the proposals, and still trying to digest it all. And I know that many of my colleagues feel the same way. We're wading through seas and seas of information, and yet we don't even know if this information is actually going to be what we're faced to deal with at the end of the day. So that, I think my concluding remarks are: sit tight, keep reading, keep your ears to the ground. If you see something that really looks like it's going to come to fruition, you can have a plan in place. Talk to your tax advisor.
Right, that makes sense. It would actually be an interesting exercise to hold the same webinar 3 years down the road and see, what actually has happened.
That's right.
Noah, any concluding remarks?
Yeah, very briefly. I really liked what Paulus said earlier. When he said that there are some bad news, but there are also some good news, low CIT rates, whatsoever. Therefore, I think in any threat there are opportunities. So you just have to see to understand what happens and see the opportunities. So I think it's wait and see, but be sharp.
Mm-hmm. Excellent. Paulus, any concluding remarks?
Yeah, happy to do so, Matteo. So I really appreciate the initiative and the fact that the U.S. wants to bring down the corporate tax rate to a potentially a 15% rate. I realize that there's like $2.5 trillion in cash sitting overseas, and with the current 35% corporate tax rate in the U.S., it's very evident the U.S. has to move, U.S. has to do something. So I fully appreciate it. Given that, though, I also hope that the plans are going to be balanced and that they're not going to be significant losers, whether it's going to be the U.S. multinational companies with serious overseas production. I hope that they're going to not lose out. And I hope the same for the production countries as like Mexico and China and also the OECD and the WTO. I hope in the end that it's going to be a win-win proposal. And I keep my fingers crossed.
Excellent. As for my closing remark, we have a comment from one of the listeners who is actually quite funny. She writes that the next Trump tweet is going to be that taxes are more complicated than anyone ever thought. So I thought that was quite amusing, given what he has said about healthcare recently.
That's right.
So with that said, I wanted to thank each one of you for participating. Thank you, Virginia. Thank you, Noah. Thank you, Paulus. I think this was a very informative discussion, and I bet our members got a lot out of this. Just quick administrative issues to get out of the way. This discussion has been recorded, so you will have access to it shortly. We will post it on our website and disseminate it in social media and so forth. And later down the road, we will have a full transcript with the entire discussion. So with that said, on behalf of TaxLinked and my colleague Masha, I'd like to thank you very much for participating, and we'll be in touch. Thank you very much.
It's great to participate.
Thank you. Thank you. Have a good evening, everyone.
Okay.
Bye.
Good night.